But yeah, there'll be a lot to talk about. Most of you, I'm assuming, will be aware of all the budget changes. We'll touch on that a little bit. We'll go through all the other things that ETF investors need to keep track of. So I reckon we'll get started. 12:03. If you're in, you're in. All right. So your end of financial year tax cheat sheet. So this is going to be an ETF focused one. A lot of this, though, is applicable to direct stocks as well. A couple of things are not. I'll point those out as we go. But it's really ETF focused since they're so common these days and are actually the most complicated when it comes to tax time. Bit of a disclaimer in here. This isn't tax advice or personal advice. If you want information on your personal circumstance, talk to your accountant or your tax advisor, the usual stuff. So we're just going to stick to the facts of how to do your tax, a few different options. Depending on what you want to do, that will be up to you to choose what you want to do. So what we'll cover. So five things. So we're going to cover the end of financial year basics. Then we're going to go into reading your AMIT or AMMA statement, which is super important. Then we're going to talk about calculating your CGT. Then we're going to look at the new tax reform stuff and then a bit on how to solve that at the end. I see some people saying getting a bit of feedback and it's fine for other people. Okay, we'll continue and hopefully the feedback thing sorts itself out. So the annual ritual. So if any of this sounds familiar, you're definitely not alone. So if you've found yourself digging through ETF statements like member statements and trying to find old dividends, that is, you're definitely not alone. We've all done that. If you've ever asked yourself, should I have sold that loser to lock in a capital loss for the end of financial year? Or how does this even work for ETFs? This is the most common one we get at Navexa as well, because the cash that lands in your account isn't just a nice number you then report to the ATO, it comes with a whole lot of baggage attached. And the one that's on a lot of people's minds is the financial year 27 clock that is ticking. So in 12 months from, like nearly 12 months from now, a whole new set of rules coming in, and that's going to um, bring in a lot of fun, which we'll get to towards the end of the presentation. So let's cover the end of financial year basics. Now, there's two general ways your investments get taxed. And one is income, and that's through dividends and distributions. And the other one is through capital gains. So that is a profit when you sell. So the difference is income, and if you own an income producing ETF, which most people do, if you own something like VAS, you're getting four distributions every year. This isn't something you can avoid. You get these every year and you've got to do something about it. And even if you're using dividend reinvestment plans or DRIPs, this still applies to you. You have to file it as income. And these types of things come in all sorts of shapes and sizes. So we've got Australian dividends, we've got franking credits, foreign income, the income components in your ETF distributions. There's a whole heap of stuff that falls into this bucket. And you usually see that on your AMMA or AMIT member statement, which is the one you get from your ETF provider around August, September, or from all of those dividend statements you get sent throughout the year that a lot of people just chuck in a drawer or throw in the bin. But these things are actually important, and we'll get to that a bit further into the presentation. The capital gains side of things is where it gets quite interesting. So this generally happens only when you sell something. So if you sell a stock or an ETF, that's a CGT event. So keep that thought in your mind as we go. ETFs do trigger capital gains regardless of whether you sell, and they can flow through to you as well. But generally, this happens when you sell something. So how we do that, sale proceeds minus your cost base with the 50% discount if held for more than 12 months. And you usually do this, like I said, at sale, and parcel selection really matters. So your FIFO, your LIFO, and we're going to get into that quite a bit in section C. So the things to look at is that income is taxed every year as it accrues, whereas capital gains are taxed only at the sale event. So looking at the income side of things, there's three things that usually trip up ETF investors. The number one is the big one, and it's that cash isn't the taxable income. So the amount that lands in your bank account is just the raw amount the distribution gives you throughout the year. You don't actually know what makes up that amount until August, September when you get your member statement. And if you've ever seen one of those, they're super boring. They have a whole heap of line items on them, and it tells you how much is franked and unfranked, and what's Australian income and what's foreign income. And there's a couple of line items on there, the cost-based adjustments, which if you've been to any of my tax webinars before, you know it's my favorite subject, and I've got a great section on that shortly. Then the second one is you get one member statement per ETF. So as people like to invest in several different ETFs, you're going to get a member statement for each one, and there's stuff you have to do with that. So it's important you keep track of those member statements, even historically. And number three is the foreign income and tax offset. So this one trips up a lot of people because depending on how you've invested, foreign income isn't always pre-filled into the ATO portal. So if you own a foreign US stock, for example, that pays a dividend, that doesn't usually get pre-filled into the ATO. And I've had some people, you can see this on Reddit and online forums, go, oh, well, if it's not pre-filled, it means I don't have to declare it. And that couldn't be further from the truth. It just means you're not reporting income you've earned and you'll end up getting in a fair bit of trouble. But a lot of ETFs through the member statements do pass through the foreign income part, but it's definitely something worth reconciling each year, particularly if you've invested in an ETF that's listed on a different exchange other than the ASX. Now, the capital gains side of things, the first one is tracking every parcel. So I'm just going to define parcel so we all are all on the same page going forward. So a parcel of shares is every time you buy an ETF, a parcel has its own number of units, its own price, its own brokerage fee, and that represents the cost base of the parcel. So if you're DCAing into an ETF every month, that is a new parcel every month. So when we talk about parcel, that's what we're talking about. So it's important you track all of those. The cost base also shift over time for ETFs through the AMIT adjustments, and they quietly change that cost base on every parcel, but we'll come to that. And then keeping records is really important. But this next section is the part that a few years ago I wouldn't have thought I'd be super interested in this, but this is one of the biggest areas of investing for Australians that I've gotten into in the last few years because I would say 90% of ETF holders have no idea the impact that this has, and it means that you're filing your taxes wrong every single year. So I'll jump into it so we can see what the hell I'm talking about. So the anatomy of an AMMA or an AMIT statement, there's a couple of things to it. So here on the left, these things are usually pre-filled into the ATO. So if you go and log into MyGov and look at the ATO section at your tax return, these things are usually pre-filled. So you've got your Australian dividends, your franking credits, your foreign income, most of the time, capital gains, interest, and other income. And this is kind of the trap because people go in, they see it pre-filled, and they're like, "Oh yeah, I own VAS, and there's all this VAS stuff in there. Job done. Don't need to do anything else." The thing people don't realize in this statement is a couple of line items, which we're talking about on the right here, and these are the cost-based adjustments. So these do not get pre-filled, and for a very good reason. It's not because they stuffed up and forgot to send it through. It's that with calculating capital gains tax, the ATO have given us a lot of flexibility in how we do it. So they don't know how to pre-fill it for you because depending on the method you choose, and I'll cover this a bit more later, you have a lot of flexibility there. So you'll see these two line items. Now, cost base excess reduces your cost base. So that means a bigger gain when you eventually sell that parcel. And a cost base shortfall increases it. So it's a smaller gain when you sell. So how that works in practice is, let's say we bought 500 units at $20. So it gives us one parcel with a cost base of $10,000. Now we get our member statement and it shows a cost base reduction of 15 cents per unit. So that means our $10,000 cost base now becomes 9,925. So if we then sell at $25, the gain is actually 2,575, not 2,500 if we ignored the cost base adjustment. Now, this $75 looks quite small, but you can see how this would stack up across every year, every ETF, every parcel that you own. And we're going to get into a more complex DCA example in a second, just to see how that um, cascades a little bit. But this is an area that you cannot ignore, and most people are ignoring it. So here's an example. So let's say you DCA, or thank you, Steve, dollar cost averaging in the chat, if I didn't make that clear. And dollar cost averaging is where you just buy the same amount of shares or units every month or every week or whatever your cadence is. You ignore the ups and downs. It just gives you the average price over time. So in this example, we're investing $500 a month, and every year we get 12 new parcels. And remember, every parcel, these blue dots, has its own number of units, its own price, its own brokerage fee, depending on who you're trading with, and that forms a different cost base for all 12. Now, at the end of that financial year, we get our member statement, and it has an adjustment on it, either up or down. We need to go and manually update each parcel to reflect that cost base. So like we saw in this one, where it was a cost base reduction of 15 cents, and we had to then adjust the parcel. If we received a cost base adjustment here of 15 cents, we would have to proportionally apply that across all 12 parcels. Sounds like a bit of a headache, but it's what you have to do if you own an ETF. Year two, we DCA again every month. We now have 24 parcels and we get our member statement. We now have to go and update all 24 parcels. Year three, 36 parcels. Year four, 48. By the fifth year of dollar cost averaging, we have 60 parcels. And when we get our member statement on the fifth year, we have to apply whatever adjustment, it might have been up or down, we need to apply that to all 60 cost bases across all 60 parcels. Now, this becomes a real headache. And I met a guy recently who has been dollar cost averaging for 10 years into a couple of ETFs. He had, like most ETF investors, never heard of cost-based adjustments and had hundreds of parcels that he had never adjusted. So it means when you go to when you go to sell some of these adjustments already need to be factored in. And so if you've been following along closely, by this fifth year, it means the first year's parcels have now been adjusted 5 different times. And so you can see how if you even miss one of those years, suddenly the cost base is completely wrong. Now, if you want to know how to do the math on this, on the Navexa YouTube channel, there's a video called How to Calculate AMIT Cost Base Adjustments. And I do a whiteboard example of exactly how to do the math on how to do this. It's relatively straightforward, and it's fine to do in your first year or two. But you can see once you're getting into year 10, you have 120 parcels to update. It becomes a bit of a nightmare. So if you're interested in the math, definitely check out that video. Now, I saw a comment in the chat I just want to touch on saying, I'd like to think that an accountant is up to speed on this requirement. Um, it's an interesting one because a lot of accountants, we have customers who have come to Navexa who their accountant has fired them as a customer because they said, you have ETFs, I'm not dealing with that, and send them away. There's plenty of other accountants as well who have come across who don't know about cost-based adjustments at all and just do the math as if they didn't exist. But there are also very good accountants, like my own accountant, who is very up to speed on how all this works. So it's definitely worth having the conversation with your accountant that they know what they're doing in this area, because there's a lot that an accountant has to handle, and this is, one of those like niche areas that not everyone's up to speed on. So definitely confirm that. So we'll move into calculating your CGT. I'm just going to have a quick sip of my hot lemon to keep my voice good.
I'll try and get the link up about that video into the chat as well.
Definitely. So CGT flows on directly from the cost base adjustments because the cost base is how you calculate CGT. So if we look at a simple example of what capital gain is that essentially you bought something for 1,000, you sell it for 2,000, you made a $1,000 capital gain, and you pay tax on the gain. So that's kind of it really simply. Currently, if you hold it for more than 12 months, then you get a 50% discount. So that $1,000 becomes $500, and that's what you would report to the ATO. Now, I hear a bunch of you thinking, hasn't the discount gone? The discount is going in a year's time. It's still here with us for the next 12 months. And for all the parcels you own now, it's still going to factor into the capital gains calculation even after July 27 next year. So the discount is not something to think, oh, it's gone, I don't need to worry about it. For all the parcels you still hold, it's still a thing that is going to have a huge impact. So now the next question is, which shares did you actually sell? So let's say we bought the same ETF twice, and we have parcel A and parcel B. And then a month later, we sell half the holding. So we bought 100 units in parcel A, 100 units in parcel B. But the difference is parcel A was $10 a unit, which gave us an $1,000 cost base. Parcel B is 15, and it gave us a $1,500 cost base. So when we sell 100 units, we get $2,000 in the bank. But that $2,000 isn't the amount that we filed to the ATO. We're trying to calculate the capital gain. So how do you calculate the capital gain in this example? Because there's two things to choose from, right? So that's where the CGT strategy comes in. And by CGT strategy, I mean things like FIFO, LIFO, min gain, max gain, and we'll get into all of that in a minute. But that's kind of what I'm talking about. So this example, we sold our 200 units for $2,000. If we use a FIFO method, which starts for first in, first out, it means we sell the oldest parcel first because it was the first in, and it's the first one that comes out. So in that case, our $2,000 sale value would be worked out against the $1,000 cost base of this parcel, and it gives us a $1,000 taxable gain. But if we use a LIFO strategy, which is last in, first out, so we're essentially selling the newest parcel first, we would work out the gain $2,000 minus $1,500, and it gives us a $500 taxable gain. So you can see either way, we get $2,000 in the bank from the sale. The difference is in which parcel we've selected for filing to the ATO. Now, that that only applies for this financial year, right? So if we did LIFO and we sell that higher price parcel first and file $500, we're still left with parcel A. So at some point in the future, when we sell again, we won't have this flexibility because we'll only have the one parcel left and we'll have to pay the higher tax then. So the choice is up to you really on which one you want to go with, because this year you might want to pay more or less tax compared to an event you know is going to happen. You might not have a, might be taking a break next year. It changes which parcel you want to sell. Now, let's have a look at a more realistic scenario where you have bought into the same ETF 5 times. So once a year over 5 years. We bought 100 units every single time and different prices every single time, which have been AMIT adjusted already, of course, because you're tracking AMIT and adjusting cost bases. Now you can see, depending on whether we do a FIFO, a max gain, or a min gain, we have a very different taxable gain outcome that we'll be filing for this financial year. So like we explained in the last one, FIFO, we're doing the oldest parcel first. So it would be 50 shares of the FY1 parcel, I mean the full amount of the FY1 parcel, and 50 of the financial year 2 parcel, which gives us a 795 gain. Now, max gain is a strategy where you use the lowest cost base first. So sometimes you want to pay the most tax in a given financial year. And there's valid reasons for that. You might have a very low income this year, so you want to realize some of those big winners now because it'll land you in a lower tax bracket. Or maybe you've had a really high income year this year and you want to minimize the gain to keep yourself out of a higher tax bracket. So there's various reasons why you'd execute these. I'm not here to tell you which one to use. That's for you and your accountant to figure out. But you can see in the max gain scenario, we'd end up selling FY1 and because it's the lowest price, and part of FY3 because it's the next lowest price parcel, and it gives us the biggest gain of 830. Whereas a minimized gain is the opposite. We choose the highest cost base parcels first. So FY5 has the highest price, so we'll use 100 of those. And then FY4 has the next highest price, and we'll use 50 of those. I'll just have another quick sip. Appreciate you bearing with my ammonia riddled left lung. Um, so you can see we have like a $405 spread on one sale. So this is why the cost base adjustments and things are not pre-filled to the ATO, because we as investors have so much flexibility in which strategy we want to execute for calculating the capital gains, which is a really good thing. But it does mean there's more of an admin burden when we're going to invest because you need, in order to execute a min gain strategy, you need very good records because you can't just on the fly think, I'm going to use minimize gain and forget about it. Because then, fast forward 5 years, do you remember which parcels you actually sold? So if we did do the min gain strategy, we need to remember that in financial year 4, we sold 50 of that parcel. So there's 50 left. And the financial year 5 parcel was all sold out. Now, if we didn't keep records that we'd sold those, and then in financial year 10, we made a sale and we put on, min gain or FIFO or whatever, we'd probably end up double selling some of those parcels. And that will get you straight into the ATO bad books. And they'll be like, hey, you've already sold these. You can't sell them again. And this, I think, is where it's another big trap investors fall into, particularly when whether you're doing it yourself or using something like Navexa, it's not something you can kind of just drop in, do this year's one, and then forget about all the data and come back in 5 years. Because if you don't have that continuity of record keeping, then you're completely you have no idea what you've sold. And that becomes a big problem as well when the ATO does want some more information. If you can't produce your records in a timely manner, that's a red flag for them to say, okay, this person doesn't actually keep records. What else have they got wrong? Whereas if they send you a letter saying, please explain, and the same day you're like, here they are, they're going to be like, oh, perfect. This person's got it under control. So double selling is a real thing. So keep that in mind as you're calculating capital gains. Now, let's talk about the CGT and tax reform from FY27. So all the stuff we've just covered is valid for today and for the last several years, since, quite a while now. So if any of that you've held ETFs for a while and thought, I haven't been adjusting cost-based adjustments, then you've already got a big piece of work to do. The new tax reform takes that complexity and adds a whole heap more complexity on top of that. So this isn't my opinion on whether the budget's good or whether the budget's bad. It doesn't really matter whether you think it's good or bad. The reality is it's now way more complicated for all investors. So you're probably aware of this, but if not, we're just going to quickly recap what's changing from next year. So the 50% discount method, which is if you hold a parcel for over 12 months, you get 50% off. That's being replaced. That's gone. And you'll now, doesn't really matter whether you hold it for 12 months or not. CPI indexation method will adjust the cost base upwards because we never deflate, to be real, we only inflate. So the cost base should only ever go upwards. There's a new 30% minimum tax on all capital gains. So the example I mentioned earlier, where you might use min gain versus max gain because you have a lower or higher income year, this particular rule is really reducing the impact of that strategy. Depending on your tax bracket, it may well still help you quite a bit. But if you took a year off or you lost your job or your business earned particularly low income, you're still going to have this 30% minimum threshold, whether you like it or not. The other thing is it's perspective. So gains accruing from today up until the end of June next year, keep the 50% discount method that we've just discussed. And then the gains accruing on the other side of 1st of July, use the new indexation method. So for all the parcels you hold today, if you've been DCAing for the last 10 years and you have 120 parcels, once we cross over 1st of July, you need impeccable records on those 120 parcels with all the adjustments. Then there's going to be a whole new system for calculating the gain after that. But we're gonna get into an example um, in just a moment. And then in FY27 on the 30th of June, it's basically going to take the price of the asset on the day, and the mechanics of it are going to be like it was deemed sold and reacquired without the CGT event, of course. And so your records at that point really matter too, because you need to know what that closing price is going to be on the day so that you can calculate the gain on the other side of it. Let's have a look at an example. So a single parcel example, so it's easy to understand. So we bought a parcel in 2023, 100 units, 20 bucks, cost base of 2,000. And then we sold all of them in 2028 sometime. Doesn't really matter, just sometime in 2028, all 100 units at $34. Now, how do we calculate the gain with this new system? So the first half is with the old system. So a $30 market value per unit on the 30th of June is now what the new cost base is. So the $20 to $30 gives us an $1,000 gain from here to here. There's also the 50% discount because we've held it for more than 12 months. So that brings the taxable gain to $500 for this side of the sale. revalue it here so it becomes a cost base of $3,000. It's then indexed 3.5%-ish for whatever inflation is in that time. I don't have a crystal ball, so it's just a guess at this point. So it gives us a cost base of 3,105. And then we do the sale minus that cost base, giving us a real gain of $295. So the two regimes then get added together. So 500 bucks plus the 295. So both sides, both systems, and it gives us the total gain of 795 for that sale. So relatively straightforward looking on a single example. The part that makes it real tricky is that calculating capital gains up until today was like a closed box system. You knew what you bought it for, you knew what you sold it for. You can calculate the capital gain without any external inputs. The new system requires an external input of CPI and knowing how to apply that CPI calculation to your cost base. So now you're kind of dependent on this external data feed as well, which isn't a huge deal, but it just makes it a lot more complicated. So now let's look at a real example. And this is not even as hardcore as a DCA person's going to have it, but this is 5 different parcels of one ETF that we bought each year. So again, we bought different prices each year. We calculate the gain up until June 27 on all of these. And then all of these were valid for the 50% discount. So they all get halved on that side of the equation. Then remember, we revalue the cost base at $30 a unit for July 1. And now the post 27 side of the game, remember it was 295 here. It's still 295 regardless of what parcel you owned because they all got revalued at that same price. So the only flexibility you have, whether you're switching from FIFO to LIFO to min gain, max gain, is the post-July side of those parcels because they're all different prices. So if we used like a min gain strategy, it would select these two bottom parcels, which would give us the lowest pre-law change gain, then plus the 295 on the other side. Or if we did a FIFO, it would use those first two parcels and give us a higher tax bill. Now, the the admin stuff is it's crazy. It's making it very complicated, but it is what it is. So, like I said, whether you love the budget or not, this is the reality going forward. Now, there's a few misconceptions that have come up around this that I wanted to quickly cover. One is that things like FIFO, min gain, max gain won't be relevant on the other side. That's not true. There's been no law change around that. So after July 27, you're still DCAing every month into an ETF. That's still 12 new parcels, all at different prices, all at different quantities, and all with different start dates of when to calculate inflation. Because, of course, inflation isn't just this static number of, 3% or 4%. Every quarter it's going up and down. So if we think about DCAing for 12 months, every quarter's parcels are affected by a new rate of inflation. So parcel selection on the other side is going to be just as important because some will have been in a high inflation period, some will be in a low inflation period, and that will shift the cost base quite a bit. So we definitely still have the flexibility of parcel selection going forward. And you can see how I've just demonstrated it, how it straddles both systems as well. So the 50% discount, even though it's getting scrapped, it will still be with us until 40, 50 years down the line when everyone's parcels have eventually been sold and the old system no longer applies to anything. But if you're in it for the long term and you've been investing and you're going to hold parcels for the next 30, 40 years, all these parcels you own today will still be using the old CGT discount method. So it's not one we can just cast out of our minds and move to a new thing. It's going to be here for some time. So, how to do all this um, and get it done for end of financial year. This is the end of financial year checklist that you have to do. So in order, 1 through to 6. So the first step is gather every AMMA or AMIT statement that you've ever had for each ETF. Now, if you haven't been adjusting your cost basis, you got to go find them all back to when you first started buying and start applying those now and recording them in a spreadsheet or recording them in the Navexa. This one is a critical step. Then number 2 is reconciling the components. So check each statement's income parts, that the pre-fill has lined up, that you have the foreign income tax offsets in there, that it matches with the cash you received in the bank. All of those things are really important to make sure that you're not getting anything wrong. Number 3 is applying this year's cost base adjustments. So you have to do this every year. Basically, every ETF adjusts it up or down. Um, I won't go into why that happens, but you can have a look at, do a quick Google on how that works, and you can look at the mechanics of how an ETF fund works. Then 4, confirm the parcels and past disposals that have happened. So like we covered, you don't want to be double selling things. So it's really important to keep track of that. Now, we didn't touch much on DRP. So I want to just quickly add that in. Every time a DRP happens, a dividend reinvestment plan, you receive extra units of shares. Each one of those extra parcels is a new parcel with its own cost base. So if you have DRP turned on as well, cost base adjustments are impacting those parcels too. So it's really important to be tracking those. And you also pay tax on the DRP as if you received it in cash. So even though you didn't get the cash, it still ultimately gets filed as if you did get the cash and then immediately bought some more ETF with it. Then number 5, for any sale, choose a method and calculate. So you can use FIFO, LIFO, min gain, max gain, and Navexa has a min CGT, which also not only factors in the highest cost base, but also factors in the 50% discount. And once we move into the new world after July 27, the min CGT algorithm will be working overtime as well because it will also be factoring in parcels adjusted by inflation too. So I'm excited to personally code that algorithm. It's going to be a good one. Number 6, you then lodge or hand over your finished report to your accountant. Now, if you use an accountant, and I have for many years, I highly recommend them because they're great at handling a lot of this complexity. Coming with, here's all my stuff adjusted, here's my final report, here's my capital gains tax report, saves you a lot of money with accountants because they don't have to do it. They just get the report and you're good to go. So that's something to consider if you want to try and minimize your accounting tax bill. So there's 2 ways to get this done. So as you might have guessed, I'm the founder of Navexa, so I'm going to briefly talk about Navexa. There's 2 options. So it's do it yourself and done for you. So the do it yourself is basically what we've just described. You use a spreadsheet or a piece of paper, or God forbid you just have it in your mind, like a lot of people seem to do as a strategy. Um, and that's where you're factoring in all the statements and tracking the DRP and all the parcels and all the adjustments and the sales strategies and all of this good stuff. Or you can have something like Navexa, which just does all this automatically. So I know we'll have a lot of Navexa customers in here, so you'll already know what I'm talking about. But you can go into the capital gains tax report and just change from FIFO to min gain, click the button, and it instantly recalculates. That is an invaluable thing to be able to do really quickly, particularly when something big event happens in life. And I've had these several times, unfortunately, where an event's come up and I have to sell some of my investments because I need to pay for, a medical procedure or car repairs or whatever it might be. Being able to see what your tax position is going to be before you sell is a critical tool to have in your toolbox because it can be the difference between paying a huge tax bill or no tax at all. And we've had plenty of customers being able to toggle from one strategy to another and get themselves into a tax position they want to be in rather than willy-nilly doing sell trades and then realizing they stuffed up big time. So definitely check that out if you don't have the time to do it yourself or the want. And finally, we have a 20% off offer for Perla customers. So if you go to navexa.com/Perla, you get 20% off your first year annual subscription, and all of this stuff can be handled automatically. Oh, now, I've been talking a hell of a lot, so there should be a lot of questions that we can get to.
Did you want me to help you just by even summarizing some of the really
Yeah,
interesting ones I saw? And
let
there
me
is a
have a
lot of
sip.
Navexa users in the chat, which is excellent. Welcome. I think some of the big things we've noticed is that there's a lot of people asking whether or not you need to actually enter the EMA or EMIT statement, even if they don't sell anything. And
Yep. Yeah,
yeah,
it's a good one. I'll cover that one now. So I had a good chat with Hayden, the CTO of Perla, on this exact thing recently. So technically, if you haven't sold, you don't need to be adjusting the cost base because you haven't sold yet. So you don't need to perform the calculation. The risk with that is, and I touched on that just recently with the example of a big life event happening, is it's all well and good to have not applied those adjustments because you don't plan on selling right up until the moment you have to sell and then realize like, oh, I own three or I own five ETFs for 10 years and I haven't done any of these cost-based adjustments and I need the money like this week. So now you get caught out and you can't make a smart decision. So you then end up selling some stuff and hoping for the best. And that is, it's just not a strategy for a serious investor to be in. So whether you use an AVIX or not, having your cost bases adjusted is a critical step because then whatever comes up, maybe you need to rebalance. Maybe you're heavily invested in the US and you don't like the AI boom or what the US is doing and you want to rebalance into something else. You can't do that effectively if you don't actually know what your cost base is because you can't, predict what the tax bill is going to be. So that's the answer. Technically, you don't have to, but really, if you're serious, you should be doing it every single year.
and I think that also answers another question here, just saying, can I do my tax declaration before I get the EMA statements in August, September if I haven't sold anything? But I think that's the same
Yeah, the,
answer.
the pre-fill won't have happened either. So until the pre-fills happened, you can't finalize it. And there's plenty of accountants I've seen saying this that if you file too early, it's a red flag as well to the ATO because they know things like ETF statements don't come out till August, September. You don't get like your statement from your employer like on July 1. It's usually, a month in or so. There's statements from all sorts of different sources that don't come out till August, September. So if you're filing in July, it's usually a red flag that you've done it wrong.
And there's a really interesting one here just about how Katie's just saying, so I can't update the CBA, Commonwealth Bank, until I receive the EMA EMIT in September, October. How does it affect the returns? If you're talking about the Commonwealth Bank of Australia, it actually doesn't have trust income, so you won't have to do or receive the EMIT statement for a stock like that.
Yeah, so yeah, I should have mentioned that as we went. So those cost-based adjustments are an ETF feature only. So we don't get those on direct stock. So if you own, CBA or BHP or whatever, cost-based adjustments can come in a different form. So there's things like return of capital, which are particular corporate action events, which we won't really get into. But the member statement is an ETF feature only.
And I guess there's the other thing is a lot of people asking about even how we handle this inside of Navexa, and I'll try and wrap a few other questions up into it. But people asking if you can have different, methods like using FIFO for something or using LIFO for something else, how the parcel selection actually works. Um, and you've just done a massive overhaul of the tax overview and the carry forward losses from year to year. But how does Navexa handle that?
Yeah, so the interesting thing about parcel selection, and this matters whether, you use Navexa or not. We talked about strategies like FIFO and LIFO and min gain, max gain. But at the end of the day, you don't have to use any of them at all. As long as you can identify the exact parcel you use to calculate in the cell, you can do what's called manual parcel selection. I think the ATO call it the specific identification allocation model or something like that. And basically, and this is a feature in Navexa too, you can just manually go and pair trades off with whatever strategy you want. So some people do a thing called parcel trimming, where they trim a bit of a few units off every single parcel at once, so kind of like an average. Or some people might want to, you know, sell a little bit more of the higher gain parcel and then use FIFO for the rest. So what that means is that year to year you can change strategy, and even within a year you can use FIFO for one ETF, min gain for another, max gain for another ETF, all within the same year. Because at the end of the day, those are just strategies for allocating which parcels were getting sold. But if you want to do it um, full manual, you can do full manual as well.
It's just we spoke before about CBA for Katie, but she actually meant CBA, the acronym of cost-based adjustment. So
Ah,
just it
it's a
was going to
good
be one
one.
of the two. Just saying I can't update the cost-based adjustment until I receive the Emma statement in September, October. And how does this affect the 2026 tax returns? I mean, you'd have to get that statement in order to
Yeah,
reflect that in the cost base. And then
absolutely.
yeah, when you've actually entered it, then it'll properly reflect the cost base for the 2026
And the fun
returns.
thing is, right, and this is a little in the weed nugget on the cost base adjustments, is you get the say you own VAS, which gives you four distributions throughout the year. The cost base adjustments, if you're going to be very correct, only apply from each distribution backwards. So the parcels you bought at the start of the year will be impacted by all four distributions cost-based adjustment, right? But if you bought a parcel towards the end of the financial year, right before the last cost-based adjustment, like the last distribution, then only the proportion of the cost-based adjustment in that last distribution actually affects the parcel. So that might be a bit too technical, but it's yeah, it gets down to that level of detail. So um yeah, I won't go on about that one. It's a bit too hardcore, but
Yeah, and there was a couple of comments saying how there's so much information and it can be quite complex. And obviously, Navexa does do this as a platform. It tries to make it easy for you. And I did post a link to the help center, just even showing how much detail we go into, so you can actually walk through it and try to understand. Because there are some people that come to us for the first time. They've been investing for years, like for decades. Uh, and they can actually come to us, have all their data loaded in, and then even if they've been using the manual parcel selection in the past, they can reflect that in Navexa too. It's not an automatic thing. It's something that you'll have to sit down and do. But once you've done it, then going forward, it's much easier.
absolutely. And if you are interested in how to do FIFO and LIFO and real world examples, I've also got in our YouTube channel a whiteboard out how to manually calculate all of that as well. So if you're interested in trying to do a DIY approach, if you go to the main Navexa YouTube channel and just search up like FIFO, there's one on min gain, max gain. I think I did one on all of them. I do a whiteboard example of a multi-parcel calculation on how to calculate all that. So that can be pretty useful if you want to attempt doing it yourself as well.
And there's just people asking about the video. There will be a video. It should go onto the to Perla's website where it's being streamed, and we'll try and have it on our channel, which I just posted the Navexa YouTube URL there. Um,
Awesome. Do we have any? We've got a couple more minutes. I'm happy to answer a few more questions if there's any. Um,
yeah, I'll just find some more. 'Cause I did see some that were.
we'll get the slides posted somewhere as well, so you
Yeah,
can take a
I put
listen.
a link to our blog. So if everyone wants to go there later in the day, we can put them up there.
Yeah,
Um,
I'll send it through to Perla as well, so they can distribute them if they want to too.
um, just look at this.
So
So
is
there's
there a discount code that you have for Perla? So yeah, if you go to navexa.com/Perla and sign up via that link, you get a 20% off your first year's annual subscription. So definitely check that link out. Will the
um,
CPI be published by the ATO? Yes, it will, and I believe it is quarterly. Um, they're going to have to figure out how they want to do this. I don't think that's been figured out yet. That'll be one of the details. I'm also waiting for the government's thoughts on cost-based adjustments combined with CPI indexation, and if they're going to make any changes to that area. But yeah, we'll wait and see for the actual detail. I think the politicians have declared what they want to do, and now the ATO is going to have to figure out how to actually implement a lot of this stuff. So we are all over those details, of course, and we'll be implementing that in the next, you know, pretty soon. So looking forward to sorting that out.
there's a question here too. Just there's a couple of questions from Matthew, just talking about one of the other brokers, like interactive brokers, where they don't actually give you because they use like it sounds like a custodial model where they pool all the investments together. They don't give you individual Emmett statements or things like that. Um, it does make it difficult, doesn't it? Like it's something that you need to usually contact them and ask for a version of that, isn't it? Because it's sort of outside of our hands.
Yeah, it's some of the providers make it very difficult to get the data. We're always working on it. This kind of ties into a question somebody asked, does Navexa only do Pearl attacks or work for other brokers? We work for every broker, so and across crypto as well if you have crypto. So we don't really mind who you're investing with. And it's even more important if you have shifted from one broker to another at a certain point to keep in mind that the trade history doesn't get shifted with you. So if you move to Perla from somewhere else in the past, Perla get here's the current quantities and what you owe, but they don't get all the trades that you made on the other broker. And you still need that data to accurately calculate your tax because they're all the parcels that you need to know about. So a tool record keeping is critical, and that's where something like Navex is really important. So as you move around different brokers, the data's still in the one place. Doesn't matter where it comes from.
And I know that you mentioned this in the actual webinar, but Perla is actually one of the uh, most integrated brokers with us, isn't it? In terms of
It is for
uh,
the best experience for a broker and using Navexa is with Perla because Perla have a direct integration with us. So when you execute a trade in Perla, it comes straight into Navexa a few moments later. So it makes it really easy. So check them out if you're looking for that kind of direct integration experience. I saw a question I want to address. Yeah, we've got 3 minutes left, so I'll try and fit in a few. Is there any reason? Oh, where did it go?
Is it about how
Lost
we
it.
don't have the AMIT data in the
Yes, that's the
Navexa
one.
platform?
So is there
Yeah.
any reason why it's not pre-filled? There is a good reason. It is very, I haven't found a reputable source yet that will have the accurate numbers. So a lot of the ETF providers publish what they call a tax component estimate, and you'll see that in the ASX announcements, and it looks very similar to your AMIT statement figures, but it's never quite right. So we've erred on the side of complete accuracy more than slightly, like mostly accurate convenience. When it comes to the numbers, they are what they are. So we treat the statement you receive as the source of truth. It's a once a year activity, so it takes, like a minute to put in, but then you've got the absolute correct numbers. But we'll see. We'll see if a better feed comes up at some point, but it seems unlikely. One more minute. What have we got? There's no
Um,
expiry on the discount, so you can check out that page whenever you want.
and I think someone else before said if I just have Perla and Navexa, is that fine? And that's not a problem. You could use it on the basic plan, which is just for one portfolio. Portfolio in Navexa is a tax entity. So yourself is one, an SMSF is another one. And if you go up to a standard plan, that unlocks the parcel tracking feature and lets you use three portfolios, but you can actually add more portfolios now as well.
Exactly. So I think we'll wrap it up there. So we're bang on time, but I really hope that you got a lot out of that, particularly the cost-based adjustment stuff. I know that freaks a lot of people out, but if you have any questions, you can definitely hit us up. We're on the usual social medias. You can come to the Navexa website and ask any questions. Check out our YouTube for all the examples on how to manually calculate a lot of this stuff. I think that'll help you if you really want to do it. And thank you for all the well wishes for me getting better. I hope so too. And I'm surprised how well my voice held out. I think that the hot lemon did the job. So pretty pleased with that.